Good day, everyone. My name is Ashmin, student ID E3EKM3133. So I'm from group 004. Today, I would like to discuss and present you about the company that we've been choosing. It's Pursuit Minerals Limited. So we're going to start our discussions about that. So the company that we choose, Pursuit Minerals Limited, is a mineral company, exploration and a project development company, founded on 2 December 2007, which is headquartered in Western Australia, advancing copper and zinc project in a world-class Australian metal provinces. The company principles, business objective are and will continue to be the acquisitions, exploration, development, and operation of a gold, silver, nickel, vanadium, and other precious minerals. It have a various location of operation: Western Australia, Queensland, Finland, and Sweden, and last but not least is Norway. So with zinc project in the heart of the Mount Isa Super Basin, Pursuit Minerals is uniquely placed to deliver value as it seeks to discover world-class deposits adjacent to exciting regional infrastructure and extract value from exciting mineral resources. So, led by a team with the wealth of experience from all sides of minerals transaction, the company understand how to generate and capture the full value of minerals projects. So it's acquired high quality vanadium projects in 2018 and has since made a great progress in delineating resources. So next we're gonna discuss about the objective of the company. So in the near term, the company objective, as we can see here, it's actually diligence on the recently acquired Buck Mountain Gold Project. It's extracting value from its exciting nickels and vanadium resources in Sweden, Finland, and Norway. So acquiring additional opportunities from its exciting nickels and vanadium, which is located in Sweden, Finland, and Norway. They have opportunities like for a new previous metal project as well. So for Australian mining industry, this company is a part of mining and exploration industry in Australia. It's an action continent with an abundant supply of minerals. So Western Australia and Queensland are the most resource-rich states, and Pursuit Minerals have projects in both Australian states. So today the Australian's mineral sectors accounts for 8% of gross domestic products. Australia is among the top 5 producers of most of the world's skills minerals commodities. So kindly, this country, Australia, is the world's largest exporter of a black coal, iron ore, alumina, lead, and zinc, and the second largest exporter are uranium. So next, we're gonna discuss and look over the location of operation. So the location have 4, which in Queensland, Sweden, Finland, and Norway actually. So this project very high value exploration and recently acquired by a company with pride. So as you can see there, Pursuit Minerals Limited has entered into a binding acquisition agreement with the mining equities and Peter Giannini to acquire the Gladiator Gold Project, comprising for a 4 exploration license located 10 kilometers northwest of Leverton in Western Australia. So in Queensland, there's 2 locations, which is called Paperbark and Blue Bush Project. And it's acquired by Pursuit in, I think, 2017, August. Drilling results to date have indicate like zinc and lead mineralization. In Sweden, they have Arjoki and Central Sweden. They have 2 projects where historic trial mining and drilling has demonstrated iron, titanium, vanadium, and mineralization. So in Finland, they have 2 Kontalainen and Karhujupuka project with a high upgraded historical mineral estimate to mineral resources in accordance with the Joint Ore Reserves Committee is standards. So for Norway, they have a tree project named as Espadalen Project, Sidel Project, and Hosanger. All have excellent infrastructure, and project tenements were granted in April 2018. So next we're going to discuss about the analysis of financial ratios. So I'm going to pass to my colleagues, team members. So they're going to discuss each and every slides regarding the financial ratios of this company. Thank you.
Hi, this is Suman Lama, student ID EMV 25125 from group 004. Here I'll be discussing about analysis of liquidity ratio. After the financial analysis of liquidity ratio for year 2018 and 2019, we observed that the current ratio and acid test ratio, which were 2.8 and in 2018 were declined to 1.8 in year 2019. Likewise, cash ratio with 2.58 and operating cash flow ratio with 3.9 decreased to 1.44 and 1.5 in the year 2019 respectively. Now we are discussing about solvency ratio. The solvency ratio examines a company's ability to meet its long-term obligations. This ratio is most often used by the prospective lenders when evaluating the company's worthiness. The intent of this comparison is to discern the ability of the target entity to remain solvent. A higher ratio percentage result indicates a company's increased ability to cover its liabilities over the long term. There are few types of solvency ratio. Some of them are debt to equity ratio, debt ratio, and proprietary ratio. Debt to equity ratio. The debt to equity ratio measures the relationship between long-term debt of the firm and its total equity. The debt equity ratio holds a lot of significance. The first, it is a great way for the company to measure its leverage of indebtedness. A low ratio means the firm is more financially secure, but it also means that the equity is diluted. Debt ratio. This ratio measures a long-term debt of the firm in comparison to its total capital employed or net fixed assets. It indicates the high financial leverage of the firm. A low ratio points to a more financially stable business, better for the creditors. But a high ratio helps the management with trading on equity that is on more income for the shareholders. Finally, we have proprietary ratio, which shows the comparison between owner's fund and total capital or net assets. A high ratio is a good indication of the financial health of the firm, which means that a larger portion of the total capital comes from equity. Thank you.
Hi, it's me, Juliani. I'm so sorry. Please ignore my background. Okay, so today I will talk about liquidity. So, I would like to say a little bit about the liquidity definition first before we go more deeply about the impact of the liquidity to a company, and then the type of the type of the liquidity, and then how we calculate all the liquidity types. So, we start from the liquidity of a company. So liquidity of a company is one of the significant aspects to look at, as it reflects a company's ability to pay off current or short-term obligations without raising any external capital. So financial liquidity means how quickly and easily a company assets can be converted into cash. For example, like assets such as stocks and bonds are highly liquid in nature and can be converted in cash just within days. Okay, so I hope you get it. And liquidity ratios normally are used as financial indicator whether a company's current asset or short-term assets will be sufficient to meet the company's obligations when they become due. So liquidity ratios reflects a financial health of a company and ability to meet its near-term debts. And liquidity can be measured through several ratios such as current ratio, asset test ratio, cash ratio, and operating cash flow ratio. And in general, a higher liquidity ratio shows a company is more liquid and has better coverage of understanding debts. And current ratio is the current ratio measures a company's ability to pay off its current liabilities or payable within 1 year with its current assets such as cash, account receivable, and inventories. The second one is like asset test ratio. It is also called as quick ratio, which measures a company's ability to meet its short-term obligation with its most liquid assets and therefore includes inventories from its current asset. The third one is cash ratio. So cash ratio determines how financially able a company is to satisfy short-term liabilities with cash and cash equivalents. And the last one is the operating cash flow ratio. This ratio measures how efficiently a business can meet present liabilities from the cash flow of its core business operations. And I'm gonna talk about a little bit about the formula. So for the current ratio equal to current assets divided by current liability. So the second one is asset test ratio is equal current ratio minus inventories divided by current liabilities. The cash ratio are equal to cash and cash equivalents divided by current liabilities. And the last one is operating cash flow ratio equal to cash flow from operations or cash flow from operations divided current liabilities. After the financial analysis of liquidity ratios for 2 years, it has been observed that current and quick test ratio were 2.8 in 2018, which decreased to 1.8 in 2019. So cash ratio and operating cash flow ratio have declined in the year 2019 as compared to previous year, which reflects less cash as in asset and cash flow into the company. So the question is what does the ratio indicate? By looking at the overall scenario, it can be said that current and past asset ratios both are good in place, which means this Pursuit Minerals company represents a healthy financial position to pay off debts in both years. However, it reduced in year 2019 by 1% due to increased investments by the company. And high cash ratio means like company have cash and cash ready assets, which represent a strong liquid state. And in the operating cash flow ratio also reduced, which indicates that cash flow into the business in 12 months has decreased. So that's all about the liquidity. Thank you.